But I think, as you can tell, the move is going to be so sharp, people have no idea what's coming.
If you're sitting in Jay Powell's seat right now, what do you do?
Welcome to Dream Richer. Do you think the years 2022 and 2023 look bright? According to Raoul Pal, the answer is a resounding no. As Mr. Raoul argues, the next few months with tighter monetary policy will bring extreme pain. Many people like to blame the Feds for extreme money printing, which has landed us in this situation. Even though that's true to some degree, because our economy has seen a sharp debasement over time. However, if the US government stopped printing money, our economy could also go into a recession. In either case, the market decides the future. Theoretically speaking, if the Feds dropped printing money right now, the economy would collapse. This is because we are running a $6 to $9 trillion deficit this year alone. Remove that money and the government would cease to exist. Tens of millions of jobs would disappear, and with it, economic activity. It would be a spiraling cycle of deflation, poverty, and misery. But more importantly, the huge business of circulating banknotes overseas would be taken over by other larger nations, such as Euro currency, the Swiss currency, Hong Kong, Singapore, or Japanese currency. By the end of this video, Raoul Pal lays out the exact blueprint for the next few months. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
It all comes together in what I think is a dramatic risk-off that happens over the next 4 to 5 weeks. Much like the end of 2018, those of you from the crypto markets will remember Bitcoin fell 50% over that period and put in the low. I think we're starting to see that kind of scary price action. The equity market as of today has put in a demarket indicator daily low, but this is around the month-end rebalance effects, and we know the month-end rebalance is going to be one of the largest ever, meaning pension funds to rebalance their portfolios have to buy a lot of equities. They're doing that. They probably need to get it done before the long weekend in the United States. After that, I think crypto is telling us it's all going to roll over again, and we'll see the big sell-off. I expect bond yields to continue to rally as they start pricing in the probability that the Fed have to pivot and the economy's gone too far and inflation is broken. I then would love to see oil break. I'm not 100% sure of that one, but I think it's likely. It's mapping very, very well oil in 2001, and oil in 2001, almost identical price action. You can overlay the charts and it collapsed 45%, much like it did in 2018. So I think that's probably coming. That changes the narrative, and eventually the Fed, sometime in the summer, are going to go, and probably after the June meeting, they're probably going to go, okay, we'll monitor the situation and maybe we won't tighten the balance sheet yet. That signal is the signal for risk assets, I believe. And I think we'll see growth end of tech, which has been utterly destroyed and is down 70% plus, and crypto, and probably gold actually, start to outperform along with bonds. Is this going to be a longer recession, in which case everything rallies and then comes back down again, the Fed have to do a lot more? Is that what brings the Fed balance sheet in? Is the markets roll over and the economy looks terrible? I'm not sure. My base case scenario is a V-shaped recovery from an absolute cliff edge, but it could be something more drawn out, in which case we've got a much nastier equity bear market to come. But we'll wait and see. So it's a pretty grim prognosis, but I think this is the opportunity I've been looking for. I've been buying technology stocks gradually on a dollar cost average basis over the last couple of months. I will probably go out another month, and that will give me hopefully this whole low period if I get this right. The weekly DMARC indicators give us between 2 and 4 weeks for this low to come in. Crypto is identical right now. We've got the bad signal of we need the dailies to get where we're going, and that's probably another week or 10 days away of this kind of price action that we've been seeing, which is pretty ugly. And the weekly indicators are somewhere between 2 weeks and 5 weeks away before we get the final capitulation low.
Jeff Bezos is bashing Joe Biden over inflation. Recently, he went on Twitter to blame the president for the sharpest spike in prices in 40 years, saying that the soaring costs facing Americans amount to regressive tax that most hurts the least affluent. This was in response to Mr. Biden's call for higher taxes on big corporations as a way to battle inflation. Mr. Biden tweeted on May 13, "You want to bring down inflation. Let's make sure the wealthiest corporations pay their fair share." Amazon and other big companies have long been the focus of criticism over corporate tax rates that can fall into single digits, because of loopholes and tax breaks that aren't available to most Americans. For instance, Amazon's financial statements show that it had a federal income tax rate of 1.2% in 2019. Just to put this into perspective, that is 13% lower than the average American's tax rate for that year.
If you listen carefully to what's going on with the tech companies, they're laying off people. Amazon said, their words, they were wildly overstaffed for demand. Everybody's built up massive inventory, so we've got an inventory liquidation to come, which drives down ISM dramatically and GDP growth. And tech companies are going to be laying off staff. Every single VC has kind of said to their investment class, hey, listen, you need to reduce your costs. And I think that message is not lost. That's what's to come, and they'll see it very fast if I'm right and ISM comes off really quick.
If you're sitting in Jay Powell's seat right now, what do you do?
It's kind of irrelevant because the market did it itself. The bond market did what it was supposed to do. It's like, inflation's coming, let's raise rates. They raise rates. Now, we don't borrow at Fed funds. We borrow at these money market rates that are driven off the actual natural interest rate curve, and it did all the tightening. And it's going to do the loosening before Jay even figures this out. So it's almost irrelevant. It's kind of suggests that you don't need the Fed except in the backstop scenario when interest rates aren't enough. That the Fed are kind of irrelevant in the equation these days, that the markets can do it. It's only in the really bad scenario when they need their balance sheet to avoid worst case outcomes. I know people are like, I hate the printing of money, but imagine if they had not in 2008-9. Imagine if they had not in the recession. I don't know how bad it would have been. So it's either a total destruction of everything or it's a destruction in your purchasing power. Nothing comes for free.
It's clear from Mr. Raoul's explanation that everyone is in a state of confusion and panic right now. Everyone from billionaires like Jeff Bezos to government administrations such as the Feds are all unsure of how to control the current economic situation. With all that said, Mr. Raoul is still very bullish on tech stocks, which he believes is the future. For example, Tesla is a leading technology growth stock that is expected to reshape our future. Everything from the way we drive our cars to interacting with people and even how we think. Do you agree with Raoul Pal? Let us know in comments below. To learn more about the latest crypto news, watch these videos here.